All right, time for some analysis on what to expect in forecasting the Aussie dollar, and also from our central bank. We are joined by George Lucas from Instreet Investment. George, great to see you.
Thanks for having me.
Thanks for coming in. Just firstly on the Iran nuclear deal, if we could just start off with that, obviously fresh news over the weekend. Any sense that this could pressure oil prices, that may catch energy markets by surprise and help global growth?
Well, if we can get the oil prices down, it's definitely going to help global growth, especially because the Europeans rely so much on oil, which is linked to coming out of the Middle Eastern area, while obviously the Americans are moving away from oil from the Middle East. So from a European point of view, if they can get the oil price down, it's going to help growth. We'll just have to wait and see. We have to wait and see whether, obviously this is a small step in the process, and whether the Iranians live up to their side of the promise, and whether the rest of the world lives up to their side. But at the moment, I don't think we're going to see a major reaction from the oil price, which has really been driven from supply issues coming out of Nigeria and Libya, rather than what's actually, kind of adjusted to what's happened in Iran already.
Okay. Just coming back now to our central bank, of course, a huge week last week with that speech from the RBA governor, talking about the possibility of intervening in currency markets. I mean, in your intervening to weaken the currency, he's open to that. I mean, could you ever see that?
Well, they have intervened in markets before. Not in a large way, but they do intervene, and usually to slow down if the market's falling, or if it's rising too quickly, to kind of cap the rise so it doesn't rise too quickly. I mean, it's going to be a big theme for 2014, this discussion about interest rates and currency, and especially because it's pretty clear that really the only reason that they cut interest rates now is to get the Australian dollar further down. But then on the other hand, with the market changing its expectations about tapering, we've seen the US dollar rally quite significantly against all major currencies, which is going to help the RBA from a point of view that it won't need to cut interest rates to keep the Australian dollar down. And we've seen the Australian dollar come down quite significantly on the back of the tapering discussion picking up again, but also on the fact that the RBA has been jawboning that the Australian dollar should be lower.
And in terms of the parts of the economy that are sensitive to interest rates, I mean, housing in particular, but I mean, we're also hearing about retail being quite positive. The Retailers Association tipping nearly $30 billion to be spent over the next 4 weeks over the lead up to Christmas. I mean, do you get the sense that maybe that lift in business confidence, consumer confidence, it is going to start to really gain traction? Yeah,
and I think the RBA did as well, and they mentioned in their minutes how interest rate sectors in the Australian economy were responding to the lower interest rates. So from that point of view, the lower interest rates are working. It's really now just the the capex coming away from the mining sector, and also the Aussie dollar sensitive sectors, which really weren't responding yet. And so I don't know whether cutting interest rates again will have any benefit for the interest rates sensitive sectors, which are already any extra benefit. It would really just be for the AU dollar. But we are going to see, we are seeing improvement in retail, and we're also seeing an improvement in housing as well.
Yeah. In terms of that capex data, I mean, do you see this week's data that's going to be released that flowing through then, that the rise in confidence to lifting in that non-mining investment intentions?
Well, we hope so, but there's been a really big disconnect between these sentiment surveys and what's actually been happening in the underlying economy. And we've always seen, consumer confidence has been quite strong, even though business confidence has been coming off. So we'll just have to wait and see. They are, at the end of the day, they're qualitative, not quantitative surveys, and so they can vary on not just what's happening in the economy, but the fact that we won the cricket could pick up everything.
Yeah. Looking at the Aussie dollar, I mean, obviously very difficult to forecast. I mean, down around this below 92 US cent level, a big slump last week. Do you see perhaps a little bit of a bounce back this week?
Well, we might see a bounce back, but what will happen is that as the US central bank begins to taper, it's going to change the way that currencies flow around the world, and we saw that happen in April, May last year, when the Japanese bank boosted its quantitative easing programs, and we saw the capital flows significantly change the way they move around the world, and that kind of put a lot of pressure on the Australian dollar. And again, we had a lot of pressure on the Australian dollar when the whole market thought tapering would start in September. So if the figures coming out of the US over the next couple of weeks are strong, and so this probability of tapering, maybe in December or January keeps increasing, then it's going to put pressure on the Australian dollar and a lot of emerging markets and a lot of emerging market currencies.
Okay. In terms then of equity markets, how does it what does it mean for equity markets? You still got to stay long?
Well, you still got to stay long because the alternative is to really be in cash or bonds, and cash interest rates are not going to be providing you high rates, and then bonds are probably going to start falling in capital value as well as their yield coming down. So even though the equity markets might, like in the US, they may only be forecasting a 10% rise in the US equity market, it's probably still a better place to be than in bonds. So we still see this Christmas rally occurring in Australia, and we still see, in 18 months' time that the Australian market could be back to 6,800.
So even though we've already had, the 30% lift year to date nearly on the S&P 500, even though we're up 16% on the ASX 200?
Yeah, there's still at least another 10 or 15 in the US market until the end of next year, and the Australian market, has been lagging the rest of the world. And so if we can see a bit of a pickup in our economy and there's a bit of a confidence about global growth, which therefore, increases sentiment towards our mining sector, we can see the Australian market continue to move upwards.
Just on that mining sector that you're talking about there, okay, we might have to leave that for another time. Unfortunately, I'm just getting the wind up now. George, thank you so much for joining us.
Thank you very much for having me.
George Lucas from Instreet Investment, always great to get his thoughts. Do stay with us. We are going to take a quick break here on First Business. We're going to get some more opening calls for you on the ASX 200 and the trends in trading to be watching this week.